Hey Bowtie Nation, Joseph Hogue with your weekly stock market update now on Sundays at noon before the week starts with the stocks to watch and the stock market news you need to see. And Nation, the SpaceX IPO is coming and will be the biggest stock offering in market history. Musk fans, Wall Street, and retail investors want in on this, but hype is how people overpay. Before the herd stampedes into this, I'm answering the only question that matters. What is the SpaceX IPO worth? I'll break it down, the financials, the valuation, everything you need before you buy. Stick around and I'll also reveal the stocks I'm watching this week, including Bloom Energy, ServiceNow, and an update for AI stocks you cannot afford to miss. But onto that IPO, because Elon Musk's SpaceX has confidentially filed for an initial public offering. An IPO could value the company as high as $2 trillion. That means one of the biggest stock offerings in market history could be right around the corner here in June, and when this one hits, expect chaos. The media will be all over it, Musk fans will swarm, and the market will be hitting the buy button on that first day like it's the Stones' last concert ever. Everyone is going to want a piece of SpaceX. With one stock, you get rockets, satellites, defense contracts, and artificial intelligence. It's not just Musk's dream of going to Mars, it's XAI and over $25 billion in revenue this year, with 12 million Starlink subscribers already. I'm going to break down what SpaceX actually does because there is a lot more here than just rockets, then reveal those leaked financial documents and what they say about valuation. I'll use my experience as a venture capital analyst to show you how Wall Street is going to set the price on this, then give you a valuation range for the IPO. What makes SpaceX potentially so valuable? It's not just one business, but several revolutionary companies stacked together. The company first changed the economics in the space race in 2002 with its reusable rockets. Instead of throwing away the rockets after each launch like a billionaire lighting cigars with Benjamins, SpaceX found a way to land those boosters and reuse them, which could one day lower launch costs by as much as 90%. Then there's Starlink, which is the cash machine right now. Starlink uses a massive network of over 10,000 satellites in orbit to deliver high-speed internet anywhere in the world. We're going to see some leaked financials next that prove this is becoming hugely profitable for SpaceX and has already signed up 12 million customers. The company's defense and government business is its secret ATM, launching military payloads, intelligence satellites, and national security missions. It means long-term contracts and a customer that will pay any price. Starship is the next-gen rocket designed for moon missions and Mars cargo, is still in its early phases, but if it can make this work at scale, it's going to unlock an entirely new industries into the space race. Finally, after its merger with XAI in February, SpaceX now has exposure to the AI infrastructure theme and social media with X. Now, SpaceX has filed confidentially with the SEC, which means it doesn't have to release its official numbers till 2 weeks before its roadshow, just before that IPO comes out. But we have some leaked numbers from analyst meetings that suggest this one could be an absolute monster financially. Revenue reportedly hit $16 billion last year and could grow 56% to $25 billion this year. Starlink is the big driver so far, with 9 million customers paying and expected to hit 12 million this year. If the leaked 60% EBITDA margin, so that core earnings profitability, applies to the satellite segment, that means Starlink alone produced $7 billion in earnings. And that would be surprisingly high profitability for an aerospace company against an industry average of just 5% net margin and even higher than competitor Iridium Communications, ticker IRDM, with its 51% margin. SpaceX also reportedly ended last year with $25 billion in cash, giving it some serious firepower to fund Starship and its future expansions. It could have as much as $50 billion in liabilities already, but a lot of that would be the debt it took on when it merged with XAI in February, which itself took on its own debt buying social site X last year. Back in my venture capital analyst days, we would value a company by comparing it to similar companies in the market. You find competitors in the same industry, see what the market is paying on price multiples right now, and that's your estimate. But that is where answering what SpaceX is actually worth gets really complicated, because it doesn't compare neatly to one company. It's part aerospace, part telecom, and part tech platform. We can still get a good idea though using the comparison feature on Seeking Alpha, laying out side by side some relevant companies to see how SpaceX stock stacks up. Here I've included Tesla to get a feel for the market's premium pricing on Elon Musk, Rocket Lab ticker RKLB for the rocket comparison, Iridium Communications ticker IRDM for satellite communications, and Amazon AMZN for the AI segment, though it's by far the weakest comparison because Amazon is also in so many other businesses itself. On revenue and the potential for SpaceX to grow 56% this year, we see it blows all of these out of the water. Tesla and Iridium are expected to post single digit growth this year, 7% for Tesla and just 3% for Iridium, while Amazon could hit 12%, and Rocket Lab is the only one even close here with a forecast for 41% revenue growth. On profitability, the 60% EBITDA margin leaked for SpaceX is probably only on its Starlink segment. It would be shockingly unexpected to see that an aerospace company spending so heavily on rocket development did anything close to that number, but even if it is only Starlink, that is still better profitability than Iridium with its 51% margin. More so here, as Starlink is such a big part of the company's current financials, that probably puts the whole company's average profitability extremely high as well, almost certainly higher than Tesla's 11% margin, and even higher than Amazon's 20% margin. I'm going to show you how to put all this together, how to use this to answer how much is SpaceX worth next. But if you want to try out that stock comparison tool, look for the link I'll leave in the description and try Seeking Alpha Premium risk-free for 7 days. It's a great feature, and you'll also get an exclusive coupon for $30 off your first year. So check out that link or just scan the QR code here. So here, we take this comparison, a company with a stronger revenue growth and higher profitability than these closest comparables, then we add a premium onto that, what the market is paying for their sales and for their EBITDA earnings. On a price to sales measure, SpaceX would certainly be worth more than 5 times valuation we see the investors paying for Iridium, and likely better than the 13x for Tesla given its profitability and growth. That 80 times price to sales ratio investors are paying for Rocket Lab times the $25 billion in expected revenue would put the company at a $2 trillion IPO, which is close to what rumors are saying lately. On an EBITDA valuation, which is what investment bankers use when pricing an IPO, again, SpaceX would likely be worth way more than any of these. Iridium trading for 13 times and Amazon trading for 19 times its earnings before interest, taxes, and depreciation, that EBITDA measure. We see the Musk bump in full effect here with Tesla trading for a lofty 135 times EBITDA, and I've no doubt that he's going to push for a price above this on SpaceX. A 150 times a ballpark estimate of $9 million EBITDA this year would price SpaceX at a $1.35 trillion, which would actually be only worth $100 billion higher than its last funding round. So we know it's going to be higher than that as well. So based on those leaked financials and this comparison research, I'd put the SpaceX IPO valuation between $1.5 trillion and $2 trillion, and likely even a little higher than that. But here's the critical question you need to be understanding, folks. What a company is worth and what the market is going to pay for it are not always the same thing. SpaceX may be worth $2 trillion and still be a terrible buy if investors stampede on that first day and bid it up to absurd levels. And remember, these are leaked financials. Once the official prospects drops in a couple of weeks, we're going to need to update everything based on real audited numbers, segment details, and the risks involved. So next week, I'm going to be following this video up with one on a deep dive into IPO stocks and whether you should buy SpaceX on the first day. I'll show you research on IPO performance, the biggest trap I learned when I was an analyst, and recent examples like Reddit surging 48% opening day, only to crash 22% within a month, or ARM Holdings up 25% on that first day, but down 24% within a month later. Looking at the stocks I'm watching this week, AI stocks are going to face a critical test on Wednesday when all 4 of the major hyperscalers, Alphabet, Amazon, Meta Platforms, and Microsoft all report their earnings. Investors are going to be watching for any updates on their capital spending budgets for AI, already topping $115 billion a quarter just from these 4 companies. Now, all except Alphabet have been aggressively cutting costs elsewhere, especially with layoffs just to protect that AI spending. The problem here is not just confirming prior spending plans, but increasing the AI spending is going to be what's needed to keep up support for infrastructure stocks like Nvidia, AMD, Broadcom, and Micron Technology, which have all boomed lately. With those hyperscalers already cutting workforce just to support their planned spending, my fear here is that they won't be reporting much of an increase in those spending plans this Wednesday, and that could at least temporarily pull the rug out from under those AI infrastructure stocks. Invitation Homes, ticker INVH, is up almost 12% since I recommended it just 4 weeks ago on that disconnect between its market value and the value of homes in its rental portfolio. And that there's still hidden value here going into the company's Wednesday earnings report too. Analysts expect the company to report revenue growth of just 1.8%, for earnings to drop slightly. Full year expectations are about the same, which is an extremely low bar to meet, and that $16 billion market cap still significantly undervalues the company's 86,000 rental properties at just 190,000 per home. That's versus a median value over 400,000 for homes nationwide. Now, I'm still watching that Road Act make its way through Congress, which could provide loopholes for these build to rent companies, but either way, Invitation is still a good value here. Bloom Energy, ticker BE, is now up over 1,200%. That's 13 times your money since recommending it on that AI power demand theme last June, and is set to report earnings this Tuesday. Power generation is still one of the biggest shortages for the AI infrastructure theme, and Bloom's fuel cell technology is still the best for providing that power quickly and at scale. But a 13 times return in a year is always going to worry me about valuation. Sales are expected to grow 60% this year and next, and with earnings doubling each year, so that growth is still there. But the valuation has gotten stretched here. Even on this year's forecast, the shares are trading for at 21 times sales and 190 times earnings. It's still a good long-term investment, but even a hiccup in Tuesday's report or a crack in that AI data center theme could send this one lower fast. So I'm taking some of my profits here for now and waiting for a better price. ServiceNow, ticker NOW, plunged 17% last Thursday on its earnings report that only slightly beat expectations for revenue and earnings. Management reported $3.77 billion in revenue, up 22% from last year and above the $3.74 billion expected. Earnings also beat forecasts, but it was the 0.75% hit the company took on its subscription revenue from delayed Middle East projects that crushed the stock. The Iran war has caused delays in data centers and tech deals across that region, delaying some of that revenue growth for this company. It also factored into forward guidance by management, with the CFO noting that our full year guidance reflects a prudent assessment of geopolitical environment. I definitely took a little bit of an incremental conservatism on this deal timing. Now, that conservatism in estimates meant ServiceNow forecasted 2026 subscription revenue to just under $15.8 billion, an increase from the prior estimate, but not enough to impress Wall Street. But against that disappointment, the company is still forecast to grow sales by 22% this year and more than 18% next to $19 billion. Earnings are expected $5 a share next year, a 20% annualized pace, and for me, making this stock just too cheap to ignore. Shares are now trading for just 5.4 times this year's expected sales, a 70% discount to its price to sales last June, and for just 20 times on a price to earnings basis. Now, I took advantage of this dip to buy 1,300 shares at $85.54, while at the same time selling call options for the July expiration, the $90 strike price. I collected $7.29 per share, which lowered my average cost on all the shares to $78.25 per share. That gives me a further 8% downside protection. This stock could drop by 8% and I wouldn't lose money, and a potential 15% upside return in just 3 months if the stock goes back to $90. Those options expire before the next earnings report, which could be a positive catalyst as well if some of those delayed subscription revenues come back. That means I'll keep the $9,500 in options cash collected. The shares could jump back higher, and I can always sell another call options against them for more cash. Now, I know that's a lot to take in, but if you want to see how I set up that covered call option strategy, or the 29 other option strategies I use to create passive income, increase returns, and reduce risk, look for the special community discount link to our Ultimate Options course in the description. Use that link and you'll save $150 off the course. You'll get all the basics to get you started, the strategy finder to make sure you're using the best strategy, the options calculator to show you exactly how much you can make, walkthroughs on all 29 strategies, and a 14-day money-back guarantee. That $150 launch discount is only available with the coupon code I'll leave in the link below, so look for that link or scan the QR code here. Updating our stock market outlook, the Fed meets for its interest rate decision this week, and nobody cares. Market odds based on interest rate futures put the odds at 99.5% that the Fed is going to hold rates steady, and investors don't see the Fed cutting rates again until October of next year. Now, that would normally be a problem for growth stocks, the Fed keeping rates higher for longer, but it obviously hasn't bothered the market lately, with the tech-heavy Nasdaq up 44% over the last year and reaching new all-time highs last week. On the plus side for interest rates, the Department of Justice dropped its case against Chair Powell on Friday, clearing the way for confirmation of Kevin Warsh as the next Fed chair and the expectation that he's going to try to cut rates faster. But again, though, nobody's really watching the Fed or interest rates right now because earnings are all investors need to send stocks to new highs, and those earnings are very, very good. About a quarter of the companies in the S&P 500 index have reported first quarter earnings so far, with a year-over-year growth of 15% in profits. It's about to get even better. At the beginning of earnings season, analysts expected companies to report about 13% profit growth. But follow the market long enough, and companies almost always beat those expectations. In fact, over the last 5 years, companies have beaten those forecasts by 7% on average. Add it all up, and we're not looking for 13 or even 15% earnings growth, but closer to a 20% jump in profits over last year, and analysts expect this growth to continue all year long. Current year profit growth of almost 19%, leveraged from almost 10% revenue growth. That takes the total earnings for companies in the S&P 500 to about $325 for the year. And before you start thinking this is just a bunch of nerdy numbers talk, consider the S&P 500 index, that main measure of the stock market, has traded at a price of about 25 times its average earnings over the last 5 years, and has hit 28 and 30 times regularly when investors are happy and willing to pay more for stocks. Take that $325 in annual earnings times the 25 times price to earnings average, and you see how the index could be not at 71.65 where it closed on Friday, but at 81.25 by early next year. That is a further 13% upside, and it doesn't even need for the PE ratio, so how expensive stocks are to reach that 28 times or higher it's been for much of this year. Now, of course, that doesn't mean that individual stocks aren't expensive, but nation, the market is not expensive at this price, and actually, you could argue it's one of the best deals we've had in years. That's why stocks continue higher, and why I'm going to continue to ride this bull market. Use the link in the description and try Seeking Alpha Premium risk-free for 7 days, plus get a $30 discount to your subscription. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.